Today's podcast is titled Tips for Early Stage Entrepreneurs, and today's interview is with CIT's Dan Henderson. This webinar is funded in part through a grant award that CIT received from the U.S. Small Business Administration. A quick overview about CIT, our mission and charter. We are CIT's mission is to create technology-based economic development strategies to accelerate innovation, imagination, and the next generation of technology and technology companies across the Commonwealth of Virginia. We're created in 1985. CIT is a non-profit corporation plugging the gaps at the earliest stages of the innovation continuum through commercialization and seed funding and other programs as it helps entrepreneurs to launch and grow high-growth technology companies and create high-paying jobs for the future. Some of the key programs that CIT has to accomplish these mission and goals is the Federal Funding Assistance Program, which works with early-stage technology companies across Virginia in their effort to learn about and secure small business innovation research and small business technology transfer, so SBIR and STTR federal grants. We have various support programs, training, workshops, webinars, mentoring support, consultant referrals, and more. The Commonwealth Research Commercialization Fund, or CRCF, which has 5 key grant programs for entrepreneurs and university researchers that are provided annually. There's an annual solicitation that typically comes out in the fall, and the awards are made by June. And those grants are typically from the $50,000 to $100K range. There is an SBIR matching grant, an STTR matching grant, commercialization grant, and a matching grant at university, as well as an eminent researcher program for university researchers. Then finally, the CIT Gap Fund. The Gap Fund invests in early stage high growth potential companies, typically anywhere from $50K to $200K investments in various technology sectors across the Commonwealth. And the Gap Fund also manages the Mach 37 Cybersecurity Accelerator Program. For any information about these programs, my contact information will be at the end. My name's Robert Brook. I'm the Director of Federal Funding Programs here at the Center for Innovative Technology. So I manage the SBIR and STTR support programs that were mentioned before. And this webinar is actually an offshoot of trying to work with and explain some of the investment principles and working with entrepreneurs that some of the earlier stage startup companies, university research spinouts, and companies that are earlier in their formation might have some interest in some of the tips that that CIT has. And we engage with hundreds of companies a year through my program and our investment funds and our grant programs. The Gap Fund, as I mentioned, is one of the key funding programs we have that we engage with, again, hundreds of companies throughout the year. Dan Henderson is one of the experts CIT has on our Gap investment team. And thanks for joining me today, Dan.
Rob, thank you for having me. Always a pleasure.
No problem. So Dan, you engage with early stage technology entrepreneurs every day, and that's where we talk a little bit about your background, kind of see what your expertise is in, and maybe get some advice that you may have for early stage technology entrepreneurs who might be earlier stage, starting up, but thinking about starting up, but more importantly, you know, they're planning to have an endeavor sometime soon. And since you engage with companies all the time, you've got a lot of feedback continually and hear what their challenges are, what their opportunities are, and I know you have a lot of good advice to provide. So tell us a little bit about your background and your work here at CIT, and then we'll move on from there.
Sure. So I've been in the world of technology for over 20 years, and for the majority of that time, 17 years, have lived and breathed in the world of early stage and seed stage startups. So for 13 years was an operator, meaning I was working in startup companies, tech companies, for two out of the 4 companies I was a founder, and then for another 2 companies I was one of the first business guys, with mixed success. So we had a couple of companies were acquired, one by a public company, and then 2 other of the companies didn't necessarily go anywhere. So I've lived through the good times, I've lived through the bad times. And then for the last 4.5 years, I've been at CIT as an investment director, working closely with seed and early stage startups.
So here at CIT, are you, how do you engage with companies? Is there a region you work in? Is there I know we have there's more than just you on the Gap team, but tell us a little bit about where you travel to and how you engage with the region and with companies.
Hmm. Sure. So there's two areas I focus on for looking for potential investments for the CIT Gap funds. One area is Richmond, and the other area is Northern Virginia. And it sort of in a nutshell, my job in part is to find and find companies, early stage, seed stage companies, and engage with the entrepreneurs and the founders, and then bring them through our investment process and perform diligence on the companies. So that means usually certainly getting to know the management teams very well, and then talking to customers and talking to channel partners, and doing deep dives into their products and the marketplaces, make sure that I understand them very well, negotiating the terms of any deal that CIT does with them. I probably end up doing the 6 to 9 investments annually, and then tracking our portfolio company's performance each week, each month, each quarter, acting as a mentor, sitting on the board as a board observer, and then at the very end of the life cycle of the company for CIT, being involved in any exits or liquidation events, in which point the money then rolls back into our CIT Gap funds, so that we can redeploy it into other Virginia-based companies.
And you often help judge pitch competitions with other organizations across the region. Tell us a little bit about how you engage with other entities out there.
Right. So in addition to sort of sourcing and investing and helping to nurture these companies any way we can, other activities that my colleagues and I, the other investment directors, often do is we are often part of the committees, technology councils that are local, for example, local to Richmond in my case. We often judge seed and early stage pitch competitions in and around Virginia, or business plan competitions. We sit on selection committees for example, the Mid-Atlantic Venture Association has a pitch competition called Tech Buzz a couple times a year, so we often sit on the selection committee for that. And probably, I would say, most importantly, there's just a ton of informal conversation and mentoring that my colleagues and I have with founders in the area. Just sort of oftentimes helping them with thinking through financing strategies and fundraising strategies, and introducing them to other angels and angel groups in the ecosystem, and that type of thing. So doing everything we can to sort of help them understand, if it's their first time through, which often it is, hey, here's what pitching is all about, and here's what fundraising is all about, and here's how investors are thinking, to the extent that it's helpful to help you refine your pitch and be successful.
So when you engage with these entrepreneurs, what are some of the maybe common mistakes that you see with these earlier stage companies that are making, that might be looking for, venture capital, since our CIT Gap Fund is an investment seed fund. So pretty much that's the area that you engage in. Obviously, the companies that come to you that are way too early, perhaps way too far along, or just not a fit. So what are some of the mistakes that you might see them often make?
Yes. So I will preface this, Rob, excellent question, by saying that I have made every single mistake, probably sadly multiple times. So there's nothing that I'm about to say here that I haven't personally done myself. I think, let's see, a few things come to mind. One is very often, once in a while, have an entrepreneur ask for an NDA, and sort of venture firms, and again, we're a venture program funded by the state of Virginia, so we're not a typical venture firm, but we are act in line with the private venture funds out there. Typically, venture funds will not sign NDAs for the reason that they are often talking about potential co-investments with other with other investors. And so it's sort of industry practice that they will not sign NDAs, so that when someone asks for an NDA, it's usually an indication that they have not been down this road before, which is fine. Everyone, it's at some point, everyone has a first time fundraising if they become an entrepreneur.
Right.
In this world that we live in. So I would say, so one mistake is sort of asking for an NDA. Another sort of very common mistake, I think, and again, I'm guilty of this myself multiple times, is being in sales mode all the time. So it's certainly important to be in a sales mode when you're pitching investors and you want to sort of communicate clearly the benefits of your product to the marketplace and the benefits that you as management bring to this company and all kinds of great stuff like that. But at some point, the most successful relationships that I've seen between investors and entrepreneurs, and I've been on both sides of the equation a number of times, is it's a true partnership. So, at some point, there needs to be sort of a kind of a stripping away of the sales veneer and a good, open, honest conversation about the company and the future and the plans and the entrepreneur's orientation, personally and professionally and that kind of thing. So certainly being in sales mode all the time, I think, is a common mistake. And then finally, what comes to mind is the question of valuation, which I think we're going to touch on later. But oftentimes, and again, I've been guilty of this myself, I've seen entrepreneurs sort of put a number on the table for a valuation, which is sort of what they think their company should be priced at for the purposes of raising money, that is often so high that it's out of line with sort of a regional market, and it sometimes is a showstopper.
All right, yeah, we'll talk about the valuation here in a moment. Just so one last question I have is in addition to the mistakes you might see entrepreneurs make, what are some key traits you look for in a good entrepreneur? Maybe someone you'd consider investing in, not that you're definitely investing in, but some key traits that make them shine above maybe the average, because not every company, more companies, there's very few companies that are investable, generally speaking, right? So what are some of those have key traits that make them a good entrepreneur? We'll talk about that. Do you have anything that comes to mind to you?
Yes, and very fair point you made about sort of investability of companies. And this is not anything that's specific. Let me just address that real quick. It's not anything specific necessarily to CIT gap funds, but generally speaking, so we probably source and screen 500 to 600 investment opportunities through our work with sort of on the ground in and around Virginia each year, and probably end up investing in 15 to 20 of them. And I don't think that that's an unusual sort of pipeline for an early stage investor. So just by the numbers, it's statistically unlikely that a company talking to a seed investor is going to get investment from them. So in terms of entrepreneurs that when I meet them, I say, wow, that person, he or she really has that sort of it factor, whatever that is. I guess I would probably boil it down to sort of self-awareness on one hand. In other words, being able to be very clear and articulate about what she or he is after. For example, hey, I want to build a company, and I don't want to necessarily go the venture route, an entrepreneur might say, because the venture route doesn't seem like it fits my personality and what I'm after, or vice versa. I do want to grow this thing. I want to scale it. I want investors. I don't necessarily care about maintaining control over the company in the short or midterm. I'm fine having, having a CEO come in a couple of years and run this thing, and I might, become the main product person, something like that. So someone who's very sort of centered and understands kind of what they're really after. I would say another trait that generally sticks out in my mind is someone who is a domain expert, or if they don't have an expertise in the domain in which they're trying to sell product, they have quickly ramped up in that space and surrounded themselves with others who are domain experts. And then finally, I think probably moving insanely fast is a mark of an entrepreneur who sort of a successful entrepreneur. Someone who might, ask for, I remember distinctly one entrepreneur who's a CEO of a portfolio company of ours, who asked for a recommendation for, I forget what, maybe he was a banker or something. And I sort of, went through the Rolodex, and this was a couple years ago, and found a couple of connections and got back to him maybe 4 days later. I said, hey, here are some folks, and let me know if you want an introduction, if I can help make an introduction. And he wrote back and said, yeah, already got a short list, narrowed it down, and I'm engaged already. So sort of that ability to just keep plugging in an incredibly high speed is something that I associate with successful entrepreneurs.
The time value of just moving it forward, that's very helpful. So you mentioned the valuation there a little bit ago. The concept of company valuation often comes up for, in my world when I'm working with companies that are applying for certain SBIR federal grants, that are more commercially focused. Ultimately, the commercialization plan, they often need to have a discussion of, okay, when the government money runs out, where are you going to get the other money? So they often need to start talking about their financing plan, and they often say we're going to get venture capital, and they're going to be doing this, or and the companies that you work with, the value, the concept of valuation. Tell us really what the valuation, you talked about the mistakes some people often make. Let's talk about what valuation is, and and kind of where that really what it means in regards to an investable company, and maybe how they're perceived as far as understanding what valuation is and how that affects their company.
Yeah, so this is a conversation that I probably personally have dozens and dozens and dozens of times a year with entrepreneurs in the area, and again, it's not something that I necessarily understood the entire time that I was an entrepreneur. So kind of learned the hard way in some cases. I think the way I think about valuations, again, which is how much a company is worth as a corporation for purposes of investment capital and share price. I think of it as a sort of a market-based exercise in the sense that there's supply and demand. The supply in any given area or region are the number of people who can write checks, and then if it's a seed round, maybe they're writing $25,000 to $100,000 seed checks. If it's a venture round, maybe they're writing $1 million checks. But I think the principle holds true that on the supply side you have the check writers, and on the demand side you have some number of companies looking for access to that investment capital, and there's the sort of basics of supply and demand hold true. Where, for example, in San Francisco, where there are many check writers and certainly many companies looking for that investment capital, you might get, and in fact, we do see prices for companies, the valuations of those early stage companies, higher than we see in New York City, where the supply and demand is different, and in the Washington D.C. and greater D.C. area, where again the supply and demand curve is different, and so to that end, the sort of advice that I wish I had known when I was an entrepreneur, that I often suggest to entrepreneurs that I meet each day, is, hey, look. If you do buy into this concept that it's a market-based exercise, then the only real way to know what your company is worth if you're raising money in any given area is to get term sheets, which from investors. And term sheets are these sort of non-contractual pieces of it's a piece of paper that basically says, hey, we intend or we're contemplating investing a certain amount of money in your company, assuming our diligence goes well and that kind of thing. And it usually has a price or a valuation. And so by having a number, 1 or 2 or 3 term sheets, is really sort of the only way to concretely have data points from the market to tell you what your company is worth. And in lieu of that, it can work against you sometimes as an entrepreneur when you're raising money. I have found, again, on both sides of the fence, to put out a number without having necessarily any feedback from the market. For example, let's say you're in the San Francisco market, where oftentimes an early stage seed stage company will get valued at $7 million to $10 million. And you start pitching your company and saying, hey, I think this company's worth $25 million without any sales. You'll probably turn off a number of investors right out of the gates and probably not have as many conversations as you might want to. Similarly, in the greater DC market, for an early stage tech company that might get a $3 million pre-money valuation, and an entrepreneur might say, hey, I think my company's worth 10, that also could similarly be a showstopper. So, or a sort of a non-start in terms of the conversation. So again, it's not necessarily, I guess my thinking is, it's not necessarily the actual number. It's really that you would be floating out there that could or could not be a showstopper. It's the number relative to what the supply and demand is like in that area. All that said, I think probably the most shrewd entrepreneurs who I have seen, when asked, what do you think your company is worth, which is a question that is quite common in a investment pitch meeting, respond something along the lines of, well, I'm not exactly sure, because I am still sort of talking to investors in this region and trying to understand, what the market, how the market might value my company. And I think that's both a wise answer and a shrewd answer. And it's advice that I often, pass along. And I myself would follow it were I to do another startup and raise money myself.
And certainly, where the position of the gap fund is a little, as you mentioned, a little bit different than your typical investment fund. We often will work with companies in a sort of a coach, in some level of coaching, because it's typically a lot of times the first time they've ever gone after venture capital. So we can kind of be more of a gentler discussion back and forth about something like valuation before they go out there to 10 serious investors, and they all kind of, maybe we can help the entrepreneur figure that out a little bit more in advance of them before they go out there. So we're the gentler investor, so to speak, before they go full bore out in the real world of things. I think that's a fair analysis of how you guys work with companies, correct?
Yeah, if we can help by providing information early on that allows them to have more productive conversations with investors, that is certainly one of our focuses. Mm-hmm.
Perfect. Well, Dan, I want to thank you for your time today. It's been interesting to learn a little bit more about your background, how you engage with entrepreneurs, a little bit about the evaluation process, and certainly if anybody has any questions, you can go to our website at CIT.org. We have events coming up at the events website, link there. You can find information about the CRCF, the Commonwealth Research Commercialization Fund, and the GAP Fund under the service lines column at CIT.org. So please, and Dan, you're reachable on the CIT website as well. And
yes, absolutely. Feel free to reach me anytime. My email is dan.henderson@CIT.org, and would love to meet any entrepreneurs who have questions about our program. And Rob, if I may add one last thing. So first of all, thank you for this opportunity to share some of the things I've learned over the years. I would say, importantly, it's important for an entrepreneur to research a potential fund that they think they might partner with. And this is, again, a mistake I made many times, because sometimes I will get companies approach me and say, hey, would you invest in my company? We're based in Utah. And very clearly on our website, it says, CIT Gap Funds only invest in Virginia-based companies. And so I would say a great way to start a partnership with an investor as a founder is to do some research on the fund, what kind of things that fund invests in, where it might invest if it has geographical preferences or limitations, and particularly if there's a partner there who might have a background that is either in the same domain or industry in which you are proposing to start your company or sell, or market that you might sell into, and that sort of research can really help propel connections and good interactions with investors.
Sage advice, sage advice. So I appreciate your insights again, and thank you everybody, and contact us if you have any questions.